Hi there, this is Mr. Evans. In this video I'm going to look at organic growth and it follows on from a video on growth and retrenchment, and we're going to look at the difference between organic growth and external growth. Organic growth we could define as when an organisation increases their sales through expanding the scope of their internal operations. So let's have a look at some methods, because this helps kind of the explanation. Ways that a business can grow organically is to expand the current asset base. We might be purchasing a shop premises and kitting it out with our logo, our brand image. We're doing it ourselves. We're maybe purpose building a new factory, okay, but we're expanding our asset base. It might be that we're just increasing our product range, so we're bringing out a new product and hoping to grow that way, attract new markets. It might be that we're employing new staff. It could be that we're entering new international markets. But the point is, this contrasts with external growth, which I'll look at in more depth in just a minute. But external growth basically involves merging with another company or doing something with another company in order to grow that way. Organic growth is, just trying to think of the best way to explain it. Growth through extending our current business. It's funded from within the business, and we'll have a look at what that means in just a second. But organic growth is an extension of our current business. We're not merging with any other businesses in any other way. Franchising is also a form of organic growth because somebody else is buying into our business. They're buying into our business name. Again, it's an extension of our current business. Our current management system is expanding, and we're taking on new assets, new people, new products to manage. It could be funded through the use of retained profits, and that would be fantastic if it was, but we might do a new share issue in order to build a new factory, or we might take out a loan in order to open a new shop. Those are external sources of finance, but it's still organic growth. When a business sells shares, it's selling off part of the ownership of the business. It's attracting finance, but it's done that in exchange for its own shares, or loan capital is going to be paid back by the business. So the business is still, it's still our brand that we're extending. Okay, the money has come from externally, but we would still define this as organic growth. And I've got a little chart there showing Lego's increase in sales. Lego are a good example of a company that have grown through their own sales. They haven't merged with other toy companies or anything like that. They've simply managed their business relatively well, although profits have fallen in 2017, and grown that way. External growth, on the other hand, is when an organisation increases their sales through integrating with other businesses. This might include a merger where the businesses agree to come together, a takeover where maybe one party doesn't particularly want to be taken over, or it could be a strategic alliance, a joint venture where businesses agree to come together for a particular purpose. So Tesco and their takeover of Booker has been approved in November 2017 when I'm recording this. This is an example of Tesco attempting to grow externally. They're taking Booker's customers and assets, and they're growing in that way. Whereas I'm not sure if I'm pronouncing it right, but Chery are a Chinese car company, and Jaguar Land Rover have entered into a joint venture with Chery in order to produce cars for the Chinese market. We can look at that in a bit more detail, but basically these organisations are working together on an agreed project, and they're hoping to gain sales in that way. Chery gain from Jaguar Land Rover's expertise in building cars. Chery know the Chinese market, and so this benefits all of them, and they're hoping to grow through this form of growth. The best way to finance a takeover is obviously internally, your retained profits It's the least risky form of finance, but often these are very expensive methods of growing which will be funded through external sources of finance, such as loans and share issues. So, what are the advantages of organic growth? Excuse me, spotted the grammatical error. Should make that consistent. So, organic growth, what are the good things about it? It tends to be more controlled than external growth. So, external growth, we'll have a look at the risks of it in more detail, but external growth can be extremely risky. If we're the management of our company, we know how our company runs, we know its brand image, we know what our culture is, and it's much easier for the management to control that than in external growth. We can maintain the culture, the management style, our brand image, our USP when we are controlling the growth, which is what organic growth is. It's internal. It's potentially less risky than external growth. So I'll look at that in the next video. And it might be associated with higher worker morale than external growth. You know, if I'm working for an expanding company, the company is doing well, maybe my pay packet is increasing as a result. That can be extremely motivating for workers who are part of a successful business that is growing in size. Whereas maybe a business that is taken over, potentially there's damage to worker morale in that situation, which we'll look at in the next video. In terms of the cons of organic growth, well, one of the benefits of external growth is that it can be done extremely quickly. You know, if I buy another company, I'm effectively buying their customers, buying their assets straight away. I get, you know, a whole network of shops or customers or whatever it is that I've bought. Whereas organic growth is much slower. It takes time to build new factories. We've got to train new staff. It's a much slower form of growth than external growth. And of course, if we're in a fast-growing market, there's the risk of missing out of opportunities. If we can, you know, if it's taking time to increase our product range or increase the number of stores, maybe we're missing out on opportunities that are available to us. So when is organic growth most likely to be appropriate? Well, if the business has a strong USP, a strong brand image, and a unique culture, it might be it might be best to try and retain that rather than run the risk of merging with another company and having that diluted. So they're quite strong reasons for growing internally, maintaining your brand image, keeping the management structure as it is. Because it does take time to do it, then maybe in a slow moving market it might be an appropriate form of growth. And mergers and acquisitions, in most countries, monopolies are illegal, and the government of many countries would look unfavourably on an organisation that is growing too big. It was quite surprising that Tesco and Booker got the go-ahead to potentially merge, because they're two really large companies. So organic growth might be really appropriate when there might be competition issues as a result of the expansion.